Hello and welcome to the Signia Wealth March Markets Commentary. My name is Ammalan Annalingam and I'm the co-head of multi-asset investments here at Signia. The big story in financial markets in March and for the first quarter of 2021 is the continued rally in US bond yields as the US economy prepares an end to all the lockdowns and stay-at-home restrictions. These positives for the economy, combined with the additional $1.9 trillion of spending agreed by the US government, amount to an increasingly pro-growth outlook with increased interest rates and therefore less appeal for government bonds. The quantum of fiscal stimulus and growth expectations also propelled US inflation expectations higher, a trend that has been ongoing since the pandemic-induced sell-off in March last year. The rally in US yields dragged up European bond yields also, despite renewed lockdowns in many European countries during March as COVID case numbers spiked and the vaccine rollout continued to progress at a far slower pace than expected. Equities were largely positive over March due to the increased growth narrative as described earlier, with the only major outlier being China, which dragged down the emerging market equity index. Chinese equities appear to have been exhibiting signs of exhaustion after having rallied 36% and 27% in 2019 and 2020 respectively. Their moderate year-to-date sell-off is in part due to some comments out of the PBOC indicating they are becoming increasingly wary of bubbles in certain asset classes such as property and credit growth. The broad-based commodity index was down on the month as both oil and gold sold off. Gold came under pressure as increased bond yields lessened the opportunity cost argument for holding a zero-yielding asset such as gold. Finally, in currencies, the DXY, which is the trade-weighted US dollar index, rallied by more than 2.5% as market expectations of US interest rate rises were brought forward from 2023 to 2022. This, however, contradicts what the Federal Reserve themselves are saying, which is that interest rates will continue to be kept at current levels throughout 2023. That's it for March. Thank you for listening, and we'll be back next month.